Breaking news tonight. The United States dollar is in freefall. And despite the White House insisting everything is fine, investors are running for the exits. This isn't just another market story. This is about the foundation of American economic power. And right now, that foundation is cracking. Here's what you need to know. The dollar just experienced its worst year in nearly a decade. We're talking about a 9% collapse in 2025, the biggest annual drop since 2017. And here's the kicker. 2026 was supposed to be the recovery year. It's not happening. The dollar index is still down roughly 1% this year. The bounce everyone expected? It lasted days, not weeks. Wall Street is nervous. Main Street should be too. So what's really going on here? Let's break it down. The White House keeps saying they support a strong dollar. Treasury officials repeat it like a mantra. A strong dollar is in America's interest. A strong dollar reflects our economic strength. But there's a problem. The market isn't buying it. And when the market doesn't believe you, your words become worthless. Goldman Sachs just put out a note that should worry everyone. They didn't mince words. Policy uncertainty is destroying dollar confidence. Investors thought they were getting pro-growth policies, tax cuts, deregulation, infrastructure spending. Instead, they got tariff threats, trade wars, confusion. Let me take you back to April 2025, Liberation Day. That's what the administration called it. The day America would finally stand up to unfair trade practices, new tariffs on multiple countries, tough talk on trade deals. America first in action. The market's reaction? Panic. The dollar dropped more than 5% in just days. 5%. For a major currency, that's catastrophic. That's the kind of move you see in emerging markets, not the world's reserve currency. And it didn't stop there. Investors started asking themselves a question, a dangerous question. If American policy is this unpredictable, why hold dollars? Why take that risk? There are alternatives. And suddenly those alternatives looked very attractive. Gold went absolutely parabolic, up more than 60% through 2025, one of the strongest rallies on record. Right now, gold is up over 70% year over year. Think about that. The traditional safe haven, the thing people buy when they don't trust anything else, just had a historic run. That's not a vote of confidence in the dollar. That's a vote of no confidence. But it's not just gold. The euro is gaining ground. The Swiss franc is strengthening. Even emerging market currencies are seeing inflows. The Brazilian real, the South African rand. Money is flowing into currencies that 5 years ago, most American investors wouldn't touch. This is a fundamental shift, and it's accelerating. Now let's talk about the Federal Reserve, because this is where things get really complicated. Kevin Warsh is the nominee for Fed chair, and he's walking into a minefield. President Trump made his position crystal clear in an NBC News interview. He said he wouldn't have nominated Warsh if he wanted to raise rates. He said there's not much doubt the Fed would lower rates. Why? Because we're way too high on interest rates. Let that sink in. The president is publicly stating his expectations for monetary policy. That's not how this is supposed to work. The Fed is supposed to be independent. It's supposed to make decisions based on economic data, not political pressure. But here we are, and the market is watching. Traders are reading between the lines. If rates come down because of political pressure rather than economic necessity, what does that say about the dollar's strength? What does it say about inflation control? What does it say about the integrity of American monetary policy? These are questions nobody wanted to ask. Now everyone is asking them. Currency analysts are seeing something they never expected. Serious discussions about alternatives to dollar dominance. Not fringe theories, not conspiracy talk. Real analysis from major financial institutions about what happens if the dollar loses its special status. For 70 years, the dollar has been the world's reserve currency. When countries trade with each other, they use dollars. When central banks hold reserves, they hold dollars. When investors want safety, they buy dollar assets. That system gave America enormous power. It allowed us to run deficits other countries couldn't dream of. It kept our borrowing costs low. It made us the indispensable nation in global finance. But privilege isn't permanent. It has to be earned. And right now, America isn't earning it. Analysts are pointing to mixed messaging from the White House and Treasury. One day it's strong dollar policy. The next day it's complaints about other countries manipulating their currencies. One week it's free trade. The next week it's tariffs. The inconsistency is becoming a pattern, and patterns create expectations. Right now, the expectation is uncertainty, and uncertainty is the enemy of confidence. Let me give you some context. When investors lose faith in a currency, it doesn't happen overnight. It's a slow process. First, they reduce their exposure. They diversify. They look for alternatives. They tell themselves it's just hedging, just being prudent. Then, if nothing changes, the trickle becomes a flood. Portfolio managers start avoiding dollar assets entirely. Central banks start reducing their dollar reserves. Companies start invoicing in other currencies. And once that momentum builds, it's very hard to reverse. We're not at the flood stage yet, but we're past the trickle. We're somewhere in between. and that should concern everyone because this isn't just about traders and hedge funds. This affects real people. A weaker dollar means higher import prices. It means your iPhone costs more, your gas costs more, your groceries cost more. Everything that comes from overseas gets more expensive. Sure, it helps exporters. American goods become more competitive abroad. But we're a consumption economy, not an export economy. We buy far more than we sell. A weak dollar hurts American consumers. And there's another problem: America's debt. We owe about $35 trillion. Most of that is denominated in dollars. If the dollar weakens too much, if inflation picks up, if interest rates have to rise to defend the currency, servicing that debt becomes much more expensive. We're talking hundreds of billions in additional interest costs. That means less money for everything else. Infrastructure, defense, social programs. It all gets squeezed. Now, I want to be balanced here. Some economists argue a weaker dollar is actually good for America. It corrects trade imbalances. It brings manufacturing back home. It makes American workers more competitive globally. There's some truth to that. But it depends on the pace and the reasons. A gradual, market-driven decline based on fundamentals is one thing. A rapid loss of confidence based on policy chaos is something else entirely. What we're seeing right now looks more like the latter. Before we continue, if you're finding this analysis valuable, hit that like button. It helps us reach more people who need to understand what's happening to their money. And subscribe so you don't miss our next deep dive. We're tracking this story as it develops, and trust me, there's a lot more coming. Now back to the dollar crisis. The question everyone is asking now is simple. Can this be fixed? The answer is yes. But it requires something Washington doesn't have much of right now: consistency, credibility, clear communication. The White House needs to decide what it actually wants: a strong dollar or a competitive dollar. You can't have both, and you definitely can't have both at the same time while also threatening trade wars and pressuring the Federal Reserve. Treasury needs to speak with one voice, not multiple officials giving different messages to different audiences. The market needs clarity. Give them ambiguity, and they'll assume the worst. The Federal Reserve needs to assert its independence, not in a confrontational way, but firmly. Monetary policy cannot be dictated by political convenience. The moment the market believes it is, credibility evaporates. And finally, policy needs to be predictable. Markets can handle almost anything except uncertainty. Give them a clear direction, even if they don't love it, and they'll adapt. Give them chaos, and they'll flee. Right now, we have chaos. But here's what gives me some hope. The American economy is still fundamentally strong. Unemployment is low, growth is positive, innovation continues. The tech sector is dominant globally. We have energy independence. We have the deepest capital markets in the world. These advantages don't disappear overnight, but they can be squandered. And that's what's at risk here. The dollar's strength isn't just about economics, it's about trust. Trust that America will honor its commitments. Trust that our institutions are solid. Trust that policy won't change on a whim. Trust that we understand the responsibility that comes with having the world's reserve currency. That trust is being tested right now. And every day that policy remains uncertain, every day that mixed messages dominate the headlines, every day that political considerations override economic logic, that trust erodes a little more. We're watching something historic unfold. The potential beginning of the end of dollar dominance. Or the wake-up call that finally forces Washington to get serious about economic policy. Which one it becomes depends entirely on what happens next. Stay informed. Stay vigilant. This story is far from over.